This is Scott Becker with the Becker Private Equity and Business Podcast. We come to you daily with short business episodes, short private equity episodes, interviews with brilliant private equity and business leaders. We try and both make sure people come away learning something and entertained some. Depends on what day it is, whether we meet those two goals. We're joined today by one of our most listened to regular guests, Matt Wolf. Matt's a senior leader at RSM, one of the largest consulting accounting firms in the world, I think fifth largest in the U.S. after the Big Four, and just a phenomenal place, phenomenal platform and firm. Matt talks to us regularly about trends he's watching in private equity. Matt, I'll ask you to take it away. What are some of the things that you have your eyes on currently?
Yeah, thanks, Scott. I think we're now, 6 days as of this recording away from the September FOMC decision. So we're waiting for that, as anxious as anybody else, still kind of expecting the 25 basis point cut. But, aside from that, I've also been kind of particularly watching movements and rumors in the IPO market. So far this month, we're not even halfway through yet. We've had 5 announcements, which is good for 2024 on a sort of monthly basis, but not great for certainly 2021 or even pre-pandemic timelines. But optimistic about it, particularly since I focus primarily on healthcare and healthcare technologies, and we're expecting some movement there. Historically, healthcare and even healthcare technology has sort of been underrepresented in the IPO markets. And as we enter this new regime, as rates sort of come down, but investors continue to reward profitability and enterprise value creation, we think there's a lot of opportunity for strong companies with strong solutions within the healthcare and healthcare technology verticals to access the public markets. And like I said, talked with even some of my clients who even 2 years ago would probably say, or even 4 years ago, say, "No, we're never going to IPO," are now thinking about it. Their sponsors are thinking about it. Of course, there's a lot, that's not indicative of the broader market, but it's just interesting to have those conversations that a few years ago just wouldn't have had because they just didn't really happen in healthcare. But now going forward, again, as we kind of continue to progress through this into this regime change where sponsors and investors will continue to reward margin creation, enterprise value growth, all of these things. And as the cost of financing comes down a little bit, I think we're poised to see some pretty interesting IPO announcements, particularly as we get a little more clarity over future rate path environments. So that's something I've been watching fairly closely over the past few weeks.
And I think that's fascinating, isn't it? Because in addition to sort of the IPO market opening up, we're also seeing some of what we've not seen in a long time is a return to go private transactions as people look to go private, to take companies private, and those become big targets too for big private equity funds that want to put money to work. So you've sort of got both these things going on, the opening up of the taking private business again, plus the IPO market. It's a fascinating sort of mix, isn't it?
Absolutely. And, I think with some of the larger take private deals we've seen over the past few months or even year, my suspicion is with some of those, they're going to be taken private. They're going to be separated, right, by business units, carved up into separate companies. And we'll probably see components of those previously public companies that were taken private IPO again sometime in the not so distant future. But I think it's a really fascinating trend, as you mentioned. We're kind of getting it at both ends, and I think it really speaks to the massive capital reallocation that is occurring and will continue to occur as we process this macroeconomic regime change.
I mean, really, really fascinating. So we start to see the IPO market open again, particularly when the public markets are so explosively valued, so highly valued, multiples again, high again, and so forth. Interest coming down just a little bit. Matt, what else is top of mind for you folks? What else are you watching closely?
There's also been a really interesting trend with private equity funds and sponsors trying to access more of a retail investor marketplace, right? Seeing funds or ETFs or other sort of clever products to tap into, certainly accredited investors, but those that maybe had not previously been approached by private equity firms, had not thought to seek them out. It maybe hasn't been an option for whatever reason. Maybe they're accredited investors, but can't, don't have 100 grand or $500,000 or whatever to put into a fund to commit to capital. Trying to expand that fundraising base. I think it just speaks to the creativity we're seeing in this fundraising environment, whether sponsors looking for more of a quote unquote sort of retail level accredited investor to invest, or expanding how they view and use private credit. But we're seeing some creativity there that's fun to watch and interesting. We'll see how that kind of influences these funds, right? LP management is such an important part of any asset manager business, and private equity certainly isn't exempt from that. So what happens as we bring in all these new LPs from not only a fund management perspective, but does that have regulatory implications downstream, right? As these funds bring on more and more broad-based investors, do regulatory bodies start to take even more notice into what's going on in private equity? Only time will tell, but it's a really interesting dynamic as we see creative funds go towards a broader and more diverse base of LPs.
And isn't that a fascinating thing when you look at that? Because you've got, when I think about that, the private equity funds going after the retail investor, what I generally think of is that, and I don't want to overstate this, that they view the retail investor much like P.T. Barnum viewed that there's a sucker born every minute. And if they've tapped out what they can get from institutional investors, really smart money, and they're starting to aggressively go after retail investors, is that because they need to, because there's not enough money left just to keep on growing with the institutional investors? Is it because they think the retail investors are easier to pluck? Because it's obviously, you've got to get a massive number of retail investors to meet up with institutional investors of capital contributed and committed. But it seems like that money might be dumber money than the institutional money, and thus it becomes a target too. And that may be a cynical view, but any thoughts there?
Yeah, it's a totally different strategy, right? Instead of sort of hunting buffalo with getting a handful of very large institutional investors, there's a whole cost benefit analysis that goes into managing that expanded LP table, right? It's a lot more work just to manage all of them, to find them, to you got to hustle hard to get those smaller checks. And I'm sure that there are some funds that's their best option, right? They've been it's particularly smaller funds, right? It's very difficult, or it's becoming more difficult. It's become more difficult for smaller funds in certain areas to compete against the largest, most established names. And we've seen institutional investors pull back commitments from smaller funds and really focus on those large sort of marquee names. And so maybe this is the best option for certain funds. Now, I think too, what could balance that is if you're going for a broad base of LPs, perhaps it makes more sense to go with a very focused fund. With a very focused investment thesis, instead of saying, we're looking across, 8 industries of 5 to 20 million EBITDA, writing majority checks, or whatever that sort of investment thesis is. Maybe there's a space for very focused funds. We're going to invest in technologies that automate business process outsourcing. And, if it's very focused, it maybe makes those conversations with the retail LPs much easier, right? If the retail LP has conviction for that same space, then boom, maybe the deal's done and you can move on, and you can cultivate your retail crowd that way with a more niche fund focus. There's trade-offs, right, for all of these different approaches, and that's one of the things that makes capital markets so great, right? We have this diverse base of actors doing very different things, and over time we'll we'll see which strategies win out in which circumstances.
No, 100%. I do view it as, and I'm always a cynic, so bear with me. But I saw Apollo's raising Apollo's raising out $1 billion plus a month from retail investors. I think these things become much more center stage when the fundraising environment gets tougher from large institutional investors. All of a sudden, people are, we're open to Main Street. We're going for retail investors, and I do view it with a little bit of cynicism, but I do think there's a lot of room for it as well. So, Matt, I think a fascinating topic. I always viewed myself as an LP that when the funds would take my money, it meant they either felt like that either there was some special reason because of the niche we're in, or because, quite frankly, their fundraising was going more challenging than they like it to be. And I overstate that, but I do think when they go after the hardcore retail investors, that it means they're struggling in fundraising elsewhere, and that's what drives it. That they can get higher percentages. They could get the retail investors to pay higher percentages or pay their full percentages. The institutional investors are looking for discounts, other things on the 2 and 20.
Absolutely.
But absolutely fascinating. Matt, I want to thank you as always for joining us on the Becker Private Equity and Business Podcast. Great topics: the IPO market opening up, the effort to go after retail investors, which I view with great cynicism, but it is what it is. I view it as more reaction to the fundraising environment than to other things, but it is what it is. And let's hope us retail investors are not, today's PT Barnum customers. Matt, thank you so much for joining us again on the Becker Private Equity and Business Podcast. Thank you very, very much.
Thank you.